Welcome to today's session on IFRS. I am C. Ashish Subedar, CPE Subcommittee Lead, and I am delighted to see every one of you here. Before we begin this event, we would like to thank His Majesty Sultan Haitham bin Tariq, our sponsors, CBFS, and our corporate supporters and corporate members. I request everyone to stand while we play the ICAI photo song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
May I now request our Vice Chairman, C.A. Unmesh, for his speech.
What do I guess? I'm not going to bore you with some speech or something. Since Gaurav is not able to make, I hope I do justice to his thoughts, which I need to pass it on to you. The first and the foremost is, as you are aware, we as Oman chapter have got the opportunity to hold the first GCC ICAI seminar on 18th and 19th of January. So we want all the members to participate in this flagship event of the GCC chapters of ICAI. So we should be lucky, we should consider ourselves lucky to host this event for the first time in the region. And how we as members of the Muscat chapter can participate. So is the question. So any answers to the question? I always like it to be a question and answer thing. How can you participate in the event?
By attending the event.
Obviously, by first is attending the event, so the registration link is up. So please register, encourage your friends to register. How else you can participate?
By spreading the word of mouth to other people in other
Correct.
countries who are not a part of the chapter.
So those who are chartered accountants but not members, please encourage them. I would go a step further. Please advertise and let the companies or the groups where you work, make them aware of the event. Let them sponsor finance professionals or Omanis to attend the event. We will be happy to consider some group discount if they are attending in large numbers of say 3 or 5.
10 minutes.
So that can be managed. How else you can participate? Sponsorship, yeah. So many of us are in a position to take decisions wherein we can extend a financial support to the chapter. This is apna ghar ka shaadi hai, right? So we need to do the best for our chapter the way we can. So we are being approached by so many members who have connected us to their marketing departments, their CEOs, their CFOs to get the sponsorship. I hope nobody is there from CPE, right? So we are using the word sponsorship. So please connect us with the people whom you know are the decision makers who can help us get some sponsorship. Or if you know your friend is into some B2C or B2B business who can help, who is interested in this participation and association with the chapter, we are happy to connect with them, explain about our event and popularize it and get some financial support out of it. Do you think any other way you can help the chapter?
Volunteering.
Volunteering. See, you all know the answers. So we have set up multiple committees and they are already started working. So in case you want to participate in any of the activities, the registration desk is stage management, dealing with the speakers, travel arrangements. There are so many things where we need help. So whatever areas you like, what is your core competency or you want to give it a shot, please connect with any of the committee members and then please participate. So that's all for the annual conference. And now we have at the end of January, we have this World Forum of Accountants on 31st, 1st and 2nd. It is going to be held in Delhi, Yashobhumi. So we have been requested by the ICAI leadership to encourage our members to participate in WOFA. I think we have got
play the video also.
yeah, let's play the video so and then I'll probably give you some insight.
Arthashastram, Dharmashastram cha means economic principles earth and ethical considerations dharma, which are central to the work of accountants. The entire world is deliberating about impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched global biofuel services. The accounting profession also has an enormous responsibility to guide the world where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOE 2022 and GLOBAC, proudly presents before the world World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession. Where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhumi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025 at the magnificent Yashobhumi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhumi, New Delhi. For more details, visit wofa.icai.org.
Yeah, so those who have not yet registered and they want to register for WOFA, they can connect with any of the management committee members. There will be some additional discount which we can arrange for the members who want to attend the event. So let's make the best use of the opportunity. And just before that, one of the points which I missed about the international conference is there is one more way you can contribute. Any guesses? For the international session? seminar we have. See, we are all experienced professionals, mostly leading the organization where we are working. So your experience can be shared with the other members by way of an article, which can be published in our souvenir. It can be aligned to the theme on the edge, or it can be a different topic also, which you believe is the important topic which needs to be shared with the other members or the students who are going to read the newsletter. So please participate, share your thoughts. The moment you go home, type out what you feel others should know, what you are aware of, and then let's share the knowledge and spread the knowledge. Okay, and the last one, I think we have announced that we are having this donation boxes as a part of our social responsibility. We are helping the cause to collect the used clothes, maybe toys or things which can be passed on to those who need. We are just a medium to collect it on behalf of our members and give it to the organization so that it reaches the right individuals. So share your share of contributing to the society. So I hope I have done justice, though Gaurav is absent today, to pass on his views, what he would have shared with the members. And I will not take too long because we are all eager to hear our best speaker of the day about the IFRS updates. So thank you very much, and see you for international conference also, and then for OFA.
It's an honor for me to introduce the speaker for the day, who does not need an introduction. He is here leading partnership or partner's position at one of the big four, Deloitte. He has a very rich experience into auditing. He has audited many large corporations within and outside Oman. He has led various accounting and financial advisory to many of the largest organizations. He is also a very good and excellent speaker on various technical topics on various forums. With this short introduction, I would welcome the speaker of the day. Thank you very much.
Good evening, everyone. Am I audible to the last person? Okay. I should have taken my specs. Still not able to. It's Jerin, right? No. Yeah. Okay. Okay. Welcome to IFRS. I was checking the time. Okay. I think we need to rush. No problem. See, we have not many big standards, big bang standards, which is immediately effect on 2024. But I put my slides into two broad categories. There are some changes which call amendments to the existing standards, which are applicable for financial year starting from 1st January 2024. That means this year. Okay, we should have discussed this last year, but anyway, these changes are not very big changes. Limited applications. If you have a particular kind of transaction, for example, supplier finance, these amendments will be applicable for you. Then there is next part of the presentation is the upcoming standards, which is applicable beyond 2025. And we will discuss two key standards which has came into effect, which is IFRS 18 and IFRS 19. How many of you are aware of these new standards, which is already an issue? IFRS 18 and IFRS 19. 1%? 2%? Okay, very good. Okay, now let's jump into the first topic. These are the amendments which are applicable for the financial year ending 31st December 2024. Okay. Now, there are three amendments. The first one, to give a background, if you look at some of these new standards, the new amendments, why they are coming into picture. Some of them are because of something went wrong. Regulators have picked, company has been presenting things wrongly, then they are amending the standard. And the largest trend which we are seeing recently in the accounting setting body is lot of new requirements coming from the users of the financial statement. They are changing the disclosures, not necessarily the measurement principle. They are improving a lot on the disclosures so that investors get a better view about the financial statement. So there will be a set of amendments which are coming to enhance the disclosure. Then there are some few things which is they issued the standards, but things were not clear. So they are coming up with interpretations and amendments. This is more of a clarification. So let's take the first one, which is supplier financing arrangement. So background to this, so I will give a quick background so that you understand why this is important. Otherwise, you may thinking why this is very important. So this is basically came because of you would have heard the story of Caroleon. What happened to Caroleon, right? Working capital issues, a lot of issues. Then they have been doing certain things in their financial statement. They were doing certain arrangements, but these were not properly disclosed in the financial statement. Okay, so and that can really vitiate the real picture and impact of certain arrangements on the financial statements because there was no very specific requirements on the standard. So what, and this amendment is applicable to that very particular, if you have such a supplier financing arrangement, then only this amendment and disclosures will be applicable. What it has come up with, this amendment requires a particular note in your financial statement over and above the existing requirement so that the users understand the kind of arrangements you have with your supplier arrangement. So what is this supplier arrangement which the amendment trying to address? This is an arrangement, for example, if I may give you an example. You have trade payables from your suppliers, say 100 million. Okay. Now you have working capital management. As part of your working capital management, what you do is you take 50 suppliers, suppliers worth 50 million. Your average credit period is 60. Okay. So what you will do, you take 50, you give it to a finance provider, and the arrangement is when the amount due on 60th day or before 60th day, the finance provider will pay to the supplier, and you will pay to the banker maybe 90 days, 120 days. What it happens is you get a better enhanced, you managing your working capital rolling. Okay. Now this has some, everything goes fine, it's okay, but this has some issues. What happens here from a liquidity and the risk perspective? Certain things happens. Firstly, previously your exposure to credit risk was between 50 parties, it's spread. Now you have one. So there is a concentration of credit risk. And if you have dealt with a bank and a supplier, who is more stricter? Banks. If you default on the due date, what happens? The hell comes down, right? So this would have happened in Caroleon. So there is a concentration of risk at different terms and conditions would be there. Yeah. So there is no specific requirement in any standard to disclose it because two things would have happened. So some of the arrangement would have been in a way that you change the terms and conditions significantly to the banker. It may appear to be a borrowing. It would have all the characteristics of a bank borrowings, like the bank charges you interest, all those kind of things. Yeah. Other thing would be you just pay a discount or those kind of arrangements. So people, what they tend to do is, for example, some people would just, instead of trade payable, all of a sudden this become other payables. Keep silent. Then what will happen if you are not able to manage the bank commitment. All of a sudden, what would happen? So this is what has happening. So this amendment is try to mitigate that particular mismanagement, or it's not, we cannot call mismanagement, of lack of disclosures because there is no particular requirement. Okay. Now what the I will quickly go through. So what the standard says, and we will try to see how this things get, how this amendment is trying to address this kind of arrangements. So first requirement is you need a separate note for this. Okay, not necessarily this is coming on the face of the income statement, but first of all, in that note, you have to describe what are different types of supplier finance arrangement you have and key terms and conditions. Like if you have a bank loan, you usually give a note, right? You have to give that disclosure. So people understand, okay, this company, even though it's, for example, in Carillion, what they're saying is the other payable was in 2010, it was 250 million. Over a period of 2019, it becomes almost $1 billion. Yeah, so this it's coming as trade instead of trade payables, it's become other payables. People would think that you are better. Yeah, so this is how it's happening without proper disclosure. So you need to give these kind of arrangements, what this kind of arrangement, nature of it, and if you have two different types of arrangement, you have to give those kind of things. And in the notes, you have to say where this supplier finance arrangement sits. Sometimes it may be under trade and other payables. Sometimes it may be under borrowings. Yeah, depending on the terms and conditions. So you have to say, this is my total. This is my total trade payables, of which 1.1 billion is supplier finance. Okay. Then you have to say, this is my total borrowings, 2,000, out of which 950 is supplier arrangement. Okay. Then so that's reporting. Then you have to disclose one more time each year what is your average credit period terms for your normal suppliers and what is your average credit terms with your supplier arrangements. So people get a lot more information about this kind of arrangements as well as how you manage your credit. Yeah. That will give them a kind of decent information about the concentration of the risk, and you know that even though it's a trade payables, effectively it's a concentration of risk to one banker, and if it goes bust, you have significant impact. Yeah, all of a sudden you effectively what you made is 90 days you make 20, but this is a rolling, right? If some other previous bills got if you are not paid, what would happen is, as per the terms and condition, maybe all this amount which currently presenting as 120 days may become immediately repayable. Yeah, so that's kind of which one? It's like comparable means you are normal. So for example, you are which is not subject to supplier finance. So normal credit period is 90 because now you obtained supplier finance. Under supplier finance now you will have 120. So you extended it. So this is one more interesting thing. There is one more disclosure which is not coming here. Here, this one. You have to say out of your trade payables, which is payable to the bank, how much of this bank has already paid to the suppliers. That is also to be disclosed. Yeah.
When you say this, it's the calculation of the average days of payment during the production.
Yes, exactly. That's why it gives a range. Yeah.
The bank will be 180 days, but you may be.
So maybe there is a one or two ranges. So what standard says is, that's why it gives a range, 85 to 90. Yeah, you are some of them. And if you have, for example, 85 to 90 days, if you have some other suppliers which is say 200 days, you have to give another bracket. Okay, so just like if it's a very varying range of payments, you may have to give more classes. Yes.
The flag is paid, it will be transferred to the whichever bank is there, that loan will stand.
Yeah.
Supply will go, right?
Yeah. So that's the disclosure here. Your liability is 1,500 to the banker, but bank has already paid 1,100 to the supplier.
So as on date, that will not be standing as a supplier.
That will not be in your books. Yeah. So, but you are giving that information for the users to understand how you are managing your supplier. In other words, this 1,100 you would have paid if you did not get on to the supplier finance arrangement. Yeah. Because this number is in your payable 1,500, which is your liability to the bank. That's the only thing which will appear in your books. But out of the 1,500 still sitting in, but bank has already paid to your suppliers. Yeah. So that gives how you managed your working capital through this arrangement.
There are two parts, I understand.
Yeah.
That one, suppose 100,000 bank taken over liability. From out of that 50,000 is suppose paid. So 50,000 going to the bank liability. 50,000 is
No. Whatever is still payable to the bank, whatever is payable to the bank will come in your books.
payable means only what he paid.
Yeah. No. Whatever you paid to the bank will be reduced from the liability. Yeah.
But he taken one liability, but it's still not due. The bank will not pay that.
No, but it's a rolling, right? You took over something you paid, you take over the new one, then it will show the end balance at the balance sheet. So that's why total payable includes this one. From the what bank balance, something is already paid by the bank. So it will give how you manage this disclosures.
So will this apply in a scenario where the bank gives you a lump sum, a short term, and
No. That's what I initially said. So this amendment does not cover other credit facilities like your bank guarantees, letter of credits, those kind of things. It's very specific to this because that's what they are trying to address, right? Anyway, the liability will come in your books as a bank liability. So.
This supplier's credit what you are talking about, it is routed through your LC transactions.
Now LC will not cover.
You have LC limit, you have a third banker who will finance this transfer.
LC is not your liability, right? Yeah.
How is work is like you have an operating, you have an LC limit with the bank, you have an LC. Okay, this might say 120 days.
So LC is a guarantee, right?
That LC is converted into supplier.
LTR, let's talk about LTR.
Okay, LTR. If it's settled, that becomes a bank liability, right? So that will come as a bank liability. That will not be covered here. Which one?
LTR will be a part of borrowing.
LTR, the bank is not taking over your liability, supplier, and it's not becoming a bank's liability. It is not happening. So only thing is, bank will settle on your behalf. So that's a bit different. So that is not covered in this arrangement. Yeah. No. Factoring is receivables. That's not part of this. It's factoring. Receivable factoring will not be covered here. Payables. Generally, we don't call payables as factoring. Generally, receivables. That's not part of this.
Basically, you are talking about.
No.
I think it's just like the total arrangement with the bank for the payable, and then we need to give a disclosure.
So you sell the payables to him,
And then
the supplier.
disclosure
Yeah.
not paid by the bank.
Yeah. Exactly.
Very common.
It's not very common at this part, but it's very common in UK and other. It's very significant, and it's very significant in construction and bigger, real estate kind of properties where you have there is a it can be a since we don't have our banks don't have it. It's a working capital management tool wherein your customer payment get delayed, but supplier gets. And sometimes people use it deliberately. That's what happened. They used it to put it as other payables and yeah, cheaper finance sometimes. Cheaper finance comes with bigger risk. Conditions will be that's what it has was happening. Now, classification of liability. This may be applicable for in the market. It's not a. It was there always in the standard, but people were kind of I wouldn't say misinterpreted or misunderstood or applying differently the requirement of the standard. How many of you have long-term loans which has bank covenants? Most covenants, right? Long-term, most of them will have covenants, right? And if you breach the covenant, what happens? It becomes current liability, right? So, and if it becomes current liabilities, yes, it's a fight. It's always a fight with the auditors and the things, because normally the argument people comes with, right? Okay, 31st December, I'm in breach of covenants. But what actually happens is, people would say, but bank says you bring then there is a process to take place. You bring the financial statement, I will look at, okay, covenants breach, then the negotiation happens, then eventually sometimes what clients, generally main argument comes, before signing the financial statement, they waive the covenants. They said, why I want to make it current liability? Already I know it's not a current liability, right? But standard is very clear. IAS 1 also was quite clear that if covenant has breached as of 31st December, that is a situation at that reporting time. That's condition existed that. It doesn't matter what happens after that. You have to reclassify it as current liabilities. Okay. So it was a more of a clarification. First thing, one more thing which it clarified in the amendment is a definition of a settlement. Okay, why it is important? Let me ask you a question. It says you would have this rolling credits, okay, which says it's due, but there is an option to roll over this thing. In that case, do you have to consider this as due within 1 year or not? Is it repayable, or you have what says is, if you don't have a unconditional right to defer the payment, it's a current liabilities. But there is an option for this one, rollover. So what is it? So yes, yeah. So that means you have to repay that. If you define that way, it becomes the old one is repayable immediately. So then it becomes current. You said it. So that was the issue. Now they clarified. Settlement means the economic outflow through a transfer of asset. In a settlement, is there an economic outflow in terms as an asset? There is no, because you are not paying cash or you are not transferring. In that case, they are saying it's not a settlement. So if there is an option, in effect, it says you don't have a liability to settle it because you have the revenue. So in that case, you can treat it as long term. Helps, I think. The previous one doesn't help you. The next one helps. Yeah. So this, the second one was then there could be another situation. One more good thing which here came with a clarification is, for example, your year end is 31st December. Okay. The last covenant period was 30th September. Next is 6 months, 31st March. Now, 30th September, you are okay. 31st December, if you look at the ratios, you are in breach. March, 150%, you will be in breach. So the question is, do you have to classify that current asset, a non-current asset to current asset, because you are in breach of covenant? Do you have to? What do you think? Yes or yes? Yes. Yes. Okay. You looks like auditors. You should not. Because the covenant the covenant date is 31st March. What standard says is, if as of 31st December you are by ratios, but contractually the bank cannot ask you to pay on December. Yeah. So you don't have to reclassify it, but it's a very significant information which the user should know. Okay, so it needs disclosure in the notes to accounts. Yeah, so you know that December it's like events occurring after the balance sheet. That's a non-adjusting event kind of things. You know that you are in trouble. It's a significant amount. So you have to say, this hasn't arisen, but 31st December, we have a breach, and there's a probability that 31st March, this can become non-current. So all of a sudden, next quarter, people should not see, it doesn't look correct, right? You present a significant amount as non-current in December, all of a sudden, March, especially for a list entity, it becomes, people you would have been knowing this because December you are on breach. So let's not hide it. Disclose, don't adjust it, but disclose as a information.
So this will modify the opinion or it has to matter?
Which one?
So what you are telling me.
It depends on how significant it is. If it's very significant, if the auditor believes or you also believe it's a significant information which had gone to the users, and if you did not disclose, it could be qualification or it could be used. So some entities it may be going concern issue. So it's a very it depends on. I leave it to you and the auditor.
He's auditor, so he's asking for his perspective.
Any questions on this? I'm not looking at every point, but I'm just trying to pass on the concepts. When? Timing of the waiver. That's the issue. I already explained. It should obtain before 31st December. If after that and before, that's the argument always. That's always been the argument. Yeah. And we always advise our clients, you have to get in advance. You go to the bank, you go, okay, 31st December, bring your financial, then I will see. That's what mostly banks, I think 99%, that's what banks are doing. That they will say, okay, as per our procedure, as per what is written in the loan agreement, December you audit, March you bring audited financials and everything, then I will look into it. I have my own process. That's right. So it's very difficult to get unless you have good relationships or good muscles, either you may get something. It's better. You know, the risk is when you go for there's other repercussion also, the commerciality. They will increase, that will use as a opportunity to increase, interest and all sorts of. Then another issue, IFRS 9 modification, everything will. So it will never be easy. Anyway, that's it. The next one, how many of you have sale and leaseback transaction? No one. Okay. It's a quite very complicated area. I will just give you the principle. What is sale and leaseback? Now, sale and leaseback is sometimes you need cash. What you will do? Sell your assets. It's very common now after COVID. You sell your assets, but you want the asset also. So what you do? You lease it back. So, and this sale and lease back, in substance, it can be of two forms. Okay, one is you sell it, but you want the asset till nobody else can use it. This is very common in aircrafts and ships and this kind of things. What you will do? You sell it, ship 2 million, you got 2 million. Okay. Now you will get into an arrangement which is called lease back. You leasing it back. You will and it will have certain terms and conditions. I will pay you this over a period of, say, remaining life of the asset is, say, 15 years. You'll say, I will pay this back to you over a period of 15 years. Yeah. Then I will be using it. I will be maintaining it. Everything is there. Then he will pay. He will decide the return in a way that it covers the 1.8 million which you got plus the interest. So it's a sale and lease back, or it's a financing arrangement. And it may some condition. Once I pay all the bills, or if I pay something early, the asset comes back to me. So it's a kind of very solid mortgage. Instead of keeping the asset with you and giving the mortgage, in effect, you transfer the ownership as a mortgage. Yeah. So say in that case, there are IFRS 15, the new IFRS 15 comes, they saying it has some conditions which says repurchase clauses and all the stuff, which try to some more of a principle based. You have to look at the substance. It is in substance what it would say is, even though you sold it, you are still controlling the asset. The control is not transferred. There is a repurchase options and other things. The things may come back to you. So it's not a sale in the first leg. Sale and lease back. First leg is sale. The sale is not satisfied. So sale is not satisfied, there is no lease back also. So then it says it's almost kind of a finance arrangement. What you can, you keep the asset in your books. The whatever money you got, it's a loan. Yeah, whatever lease payment you are paying is principal and interest. You have to do it that way. Okay. So that is the asset is not a sale. I am not going into much detail. It requires a day to do this. The problem is the other one, where you see that you sold the asset, you got the money, and you are, for example, you are leasing it back for whatever reasons. Still I need for another, its remaining life is say 20 years. Next 5 or 10 years, I will lease it back. I will pay, but that generally then that consideration will not include the fair value at that time. Maybe proportionate, I will pay. After 10 years, we will see. We may take, or you can take it, whatever it is. So that is a kind of proper sale and lease back, because in that case, the first leg is satisfied. The sale has taken place. You got the money. Okay. Debit, bank, credit. Generally what we would say, you do the asset, right? You have to derecognize the asset. Okay, you derecognize the asset. The issue is sometimes we say, then we will say, okay, we have a right of use asset and a lease liability. We put right of use asset liability. Journal entry doesn't tie up. Will it? Will not. So general perception is, in that case, we will put the difference in the profit or loss. That's a general principle. Derecognition, any balance, we put it in a profit and loss. But before that, make sure the numbers are correct. Don't dump it. Anyway, so that's a kind of IFRS. But standard says it's not that way. Amendment clarify more. For example, it can give a very different profit and loss. Like for example, your lease payment sometimes may have a significant variable. After introducing the standard, they came up with, sometimes they do arrangement in a way that, you know, the lease payment, right? For example, you make it variable. What if you remember lease standard, what it says, where variable payment will not be part of lease liability. So lease liability right of uses are less, and maybe the profit may be a completely different number. Okay, so they came up with a clarification. So how does this works is, as a principle, it says the measurement of lease liability, measurement of profit, and measurement of right of use asset on the day one, the different the measurement principle is different from the usual right of use asset and liability calculations. It goes by, so first of all, they says 2 entries are clear. The sales consideration, you got it from the sale, is debit bank, okay, because you got the cash. You have to derecognize the asset, the carrying value of the asset you are selling, that is your carrying value of the asset, that is credit, that is also correct. Now you have two new items coming into your books, which is right of use asset and a lease liability and a gain on sale, right? When you sell, for example, the carrying value of the asset is 8, for example, 1 million. If you are selling this for 1.5 million, there is a half a million. What it says that you should not recognize that half a million in the P&L. Okay, you have to decide. You sold an asset of say 1 million. How much of that 1 million you are still carrying in your books as right of use asset? So how you will decide that? And standard kept quiet. You have to say a portion of that you have to decide, keep it in right of use asset. And standard says there are 4 ways people have been doing. One is the remaining useful life of the asset is say 15 years. You are leasing it back for 5 years. So 1/3 of the carrying amount you can still keep it as right of use asset. It's quite different from the right of use asset calculation in the lease this one. Okay. Now how much you kept? 1/3 you kept. How much you transferred? 2/3. And it says the day when we said half a million there is a profit. 2/3 of that profit, which is difference between the fair value and this one, you put that into your profit. Now instead of gain and loss becoming balancing number, now the balancing number is what? Lease liability. That is a lease liability is the balancing number. Strange, right? But that's how it is saying. But it's quite different from the, what you have to keep in mind is it's not quite, it's completely different from the lease liability and right of use asset calculation which you would have done in the usual leasing model. Yeah, it's a different calculation. And then the lease liability, how you measure the subsequent lease liability. So you have to estimate, for example, even if it's a variable payment, you have to estimate that variable payment. Usually what happens? We exclude a variable lease. In this calculation, you have to calculate the estimated lease payment and you have to come up with a lease model with the incremental rate and the estimated lease payment. Yeah. Then it says subsequently you never change the lease payment schedule. If any change in the lease payment variable or anything, that portion goes to P&L. So I give you an example. I think it may be more of theoretical if you don't have lease sale and lease back. If you have experience, it's quite complex. And I have seen different people calculating. Generally, you right of use different people you get the same number. But here you can get different number. For example, the amount of right of use asset which you need to keep in books of accounts, you can do it in 3 different ways. One is based on the useful life. Other thing may be fair value. Fair value of the asset. Today, fair value of the asset when you transfer the asset. Proportionately you can do. You can do fair value of the asset versus proportion of the lease liability. 3 different ways. Okay. First of all, as I mentioned, whatever amount you got, you put it into bank. Right of use asset, you said 25% you are still keeping based on any of the 3 methods. So, which is 150 was the 1 million was your carrying amount. Okay, 25% of the carrying amount you are keeping it as right of use asset. 180, which was the fair value at the time selling price you got, and the carrying amount, which was 800,000 was the profit. Okay. The asset you de-recognized 1 million. Okay. Profit 75% of the 800, because 800 75% you transfer to the other guy, 25% you are keeping. That will be coming as profit. Remaining is lease liability. And this lease liability, then you have to create your own schedule with that the interest and all the stuff. Yeah. So for example, for 50, your incremental borrowing cost, different methods. One method is 450 is your lease liability, you know. Okay. Your incremental borrowing cost is 6. From that you will know what would have been your lease payments, work reverse. Any amount which you are going to pay in the future over and above that lease payment, it will go to P&L as a variable lease payment. It's all reverse calculation. Okay. Every big four, and they have a lot of examples, and I have seen everybody calculating little differently. So if you have it, lease sale and lease back, be very careful.
Where is this common as such? In which part of the world? So first of all, it is common only in the USA, Canada, Australia, New Zealand, South Africa.
Which ones?
Sale come lease back transaction.
Oh, a lot of. Here, if you have.
There was a big one, Oman. They
Yeah,
sold all the
yeah,
towers.
yeah.
They leased back.
NBFC and Oman also they do design.
There's sale, Oman towers, Oman, but the aircrafts, ships, there are. And some of them are sale and not lease back. It's a financing arrangement. That's quite common. But there has to be very careful. I have seen different. Even to me, it was a bit complicated in that.
It has to take place. Is it separately as one as a lesser and one as a lessee, or we can let it off?
Which one?
The accounting of it for the sale come lease back transactions.
No, you cannot. There is you are always a lessee. If you sold it, then he is a lessor. You will be lessee in that case. Asset will be in his books. For example, in Omantel, the towers will be in his book. Depending on the arrangements, it may say lease back. And that profit calculation, it's very tricky, difficult. And you can derive different results. For example, right of use asset, you can determine how much of the right of use asset I say. It can be 25, it can be 30, 40, depending on which criteria you use. Are you using the right of useful life criteria, or are you using fair value criteria, or you are using the lease payment versus a fair value? The right of use asset will change, right? That if you say 35, then the profit also will change. Then the lease liability will change. Lease liability change, subsequent measurement will also change, interest, everything. So you can run 4 or 5 models and you can choose one. So, but the thing is, it's a bit, it's fun if you if you really get into it, but quite complicated. Now that's our first part. Okay, the amendments. Any questions? We move to.
If somebody already leased, like say land you have 25 years lease, paying 1,000 per month, but I sublease 10,000 per month for 15 years. So this will come.
No, this is not that. That's sublease. It's a completely different. Okay. Yeah. So that's a sublease concept. You need to see what happens. That's a completely different concept. You need to see. You are leasing it for 100 years, and you are subleasing it for 100 years. Then it's a sublease. You have to de-recognize your right of use asset, and you have to put the lease receivables. It has its own. Sometimes there can be some profit or loss at that time. Yeah.
I have one question. In this case, I think in the contract to recognize it as a sale and lease back, I think the condition to buy back, it must be a mandatory condition, right? Or it can be an optional situation.
So that you have to go to IFRS 15. So that's the first leg, whether it's a sale or not.
Yes.
So what IFRS 15 says is not necessary. It should come this one. Even if it's an option, then you have to assess the option. How likely it is going to happen. For example, if you are a flight which with Oman Air's everything ship, or it's a LNG ship which is only your guys can use it, then the option price, it's a commercial transaction. No, you will always devise in a way that I will take it back. So you have to, it's a judgmental, but that option you have to see what is the probability of that option you are going to take it back.
Because this transaction is quite common in real estate. Now a lot of builders are selling a lot of properties with an option to buy back. So whether it will be considered.
It may be. But is there a lease back there? That's another question. In that case, it may be pure IFRS 15. IFRS 15 says you cannot recognize that as a sale until It will sit as an asset in your books.
They are giving some kind of option to lease back, and then they will let it out to someone.
If it's a lease, there is a lease back arrangement to him. There is a lease payment, right? In this case, what you will pay him back the money he paid you, or the one you will reimburse him. That's the kind of thing. So that real estate is purely IFRS 15. You have to really look at IFRS 15. Has the sale taken place or not? When you have a repurchase kind of thing. So it's a common in real estate, and there are certain situations it's very difficult to judge. It's completely a judgment.
Because it's optional, like they may or may not.
It's a judgment. It depends on the market price at that time, how you devised your this, who has the option. You have the option or he has the option. Even in that case, you have to whether he will be able to, or he exercise that one. And it can be really happen that you recognize sale and it comes back. So that's a significant judgment. It requires a lot of disclosure under IFRS 15. Yeah. So two new standards, IFRS 18 and IFRS 19, already in issue. Only one person said he knows about, two people, IFRS 18. Any idea what is IFRS 18?
It's a replacement of IFRS 1.
IAS 1, yes.
IAS 1, sorry.
The IAS 1 deals with what? Yeah, presentation of balance sheet, income statement. It's a first standard, yeah, which says what should be the components of the financial statement. It says you need balance sheet, you need income statement, you need notes, you need statement of changes, you need cash flow, and how the balance sheet should be presented, how the income statement should be presented. All these things comes in IFRS. It's a starting point. Now, what it says is no more IAS 1. It's replaced by IFRS 18. So this standard came as a background. The standard came from a investor's perspective, okay, to address some of their requirement. Few concerns. When the standard stated, very interesting suggestions were there, but eventually it came up to a bit different, but it's trying to meet the objectives. One of the example, in the income statement, one of the key flavor of any financial, if you are an investor, is to comparability, right? For example, I am investing in two companies. What are two similar companies? Maybe Raisut Cement and Oman Cement, or 2 or 3 banks, right? So you want to analyze which one is good. So what is a major issue which we find? For example, if you want to compare Omantel and Ooredoo, for example, people want to compare it. So ideally, everything should be similar in the income statement, right? But when you really go into see the income statements, sometimes it's not comparable. It may be deliberate also so by the people, the users. They never give it. For example, some people gives gross profit, this profit, that, this, by function, by nature, then operating profit, and some guys just put everything and say operating profit. So what is my gross profit? And how you classify by nature, function. So what happens is, even though, for example, even though it's the same industry, same nature, for example, entity A gives gross profit, operating profit. Entity B gives only operating profit. Okay? So gross profit is not comparable. Then when it comes to operating profit, the way he present operating profit is different. For example, he gave operating profit, then he gives some other numbers, then he comes to profit before tax. So it's not comparable. Okay. So this was one of the issues with the investors, with the income statement. Another thing is stories. You would have seen in the financial statement reports. I call it stories, but they call it differently in annual management analysis and discussion reports. They will never give you a profit. They will always give EBITDA, adjusted profit, that number, this number. And what is the problem with the investors? Investors don't know how they computed this. How they computed EBITDA, how they computed adjusted profit. Sometimes they got adjusted EBITDA also. recurring profits, a lot of things coming in. And everybody gives a different, and there is no idea. Nobody audited this number. So there's one, and believe me, those are very critical information. Like EBITDA is a very critical information. The first, when the initial draft came, one of the suggestion was to give on the income statement EBITDA. EBITDA want to be processed, or they call it profit, some other term they used. It's not earnings before, it was the proposal. So everybody gives EBITDA, and so if it's a requirement, what will happen? Everybody will, two things happens. One is, there is a consistency how you measure it. Secondly, it will get audited. Okay. Now in the management analysis reports, you have what you want. There is not much narration about it. Secondly, it's not getting audited, and there is no consistency. This year you measure EBITDA in this way. Next year you may call it adjusted EBITDA. Okay, this can happen. Okay, so that was one of them. These are the things which this particular standard, replacing IFRS 1 with IFRS 8, is trying to achieve. Clear? Good thing about is, many things they carry forward from IAS 1 to IFRS 18. Things like what is financial statement, what is income, many of the definitions, what should be part of, those many things, common things, materiality and all those things they have brought forward as it is to IFRS 18. Balance sheet format, there is no much changes. Only minor changes. They said if it's a goodwill, if you are presenting it in the note, for example, sometimes people put goodwill under intangible asset. They said no, it should come as a separate line item on the balance sheet. So balance sheet almost intact. Statement of changes, comprehensive income, no changes. Cash flow, there is no much change. But the only thing is there were some accounting policy choice. For example, interest received and paid. There was an accounting policy choice whether you put it in the financing activity or financing activity, depending on. There is an accounting policy choice. Dividend, interest income, interest expense. There is some changes. Other than that, cash flow remains same. Most of the changes are in the presentation of your income statement, and it brought a new requirement with respect to, they call it management performance measures, which is the numbers, EBITDA, those kind of things, which you put it in the annual director's report and all, but not part, previously it was not part of financial statements. So there is a new requirement with respect to that one. It's going to become your part of your financial statement. How? We will see. Okay. So what it says. Now, previously, there are two changes on the classifications, right? Previously, we say operating profit, gross profit, those kind of things. Okay. Now, what standard says is, first thing is, and the IAS 1, there is only mandatory subtotal. There was only two mandatory subtotals. One was profit before income tax. That was a mandatory. Rest is people, that's why there was a change. Rest people do. It's as a practice. Some people gives gross profit, some people give operating profit, whatever. Under mandatory total under IAS 1 was profit before tax, income tax, discontinued operation. That's one. Now they are saying you need more subtotals and you need to classify all your expenses and incomes under three categories. Basically 5 categories. One is income and expense from operating activities, income and expense from investing activities, income and expenses from financing activities. Sound very familiar? Similar to cash flow. Yeah? Then you have to give some subtotals, mandatory subtotals. First subtotal is operating profit. So you classify all and income expense. There is a criteria, which are the incomes and expenses, which are operating profit. You put everything, and after that you give operating profit. Yeah. So if you apply this properly, two similar companies, if their report operating profit is going to be same. First thing is going to be very similar. Secondly, it's a mandatory total. Okay. Then you have to define what is investing activities. Okay. Then you put all incomes and expenses that related to investing activities. Then you get a mandatory subtotal, which was not there, which is profit before financing and income tax, which is, in other words, it's profit from operating and investing. Okay. Then you put all income and expense from financing activities. Then you get the previous IAS1 total, which is profit before interest. So first you have to reclassify in between two mandatory totals comes operating profit and this one. If you diligently and properly followed, companies with similar nature will have the subtotals. Yeah, subtotals will be comparable. In between how we present, it's okay. It's not. It doesn't matter, right? End of the day, it's not. But at the key numbers, you get it. Okay, that's one. So the question is, what is operating activities? Main business. Okay. Then it says all your main activities plus if something doesn't fit into investment or financing, it will also coming into operating. Then what is investing activities? Investing activities, they say income and expense from an asset which is independent or largely independent cash flows. For example, your property plant equipment, is it largely gives you an independent cash flow? No, because it's used in the operation. No, it's integrated. But if you have an investment property which sits there, it may be you have individual shares and all. Those shares, financial asset, they independently gives you.
Can we say simply that if it is classified your investment in a balance sheet, any income from there?
Yes, but those investment by character they will be independent, right? It will be independent. This one. It will be basically interest incomes. If you have an investment property, the rental income from there, yeah. Then you will have, generally that asset side. Okay. Then another thing is financing activities, which they says any income or expenses coming from your financial liabilities, which can be loans. It can be two types. One is your loans and other things. Other may be you may have some liabilities, which is not really a financing, but for example, IFRS 15 contract liabilities. Lease liabilities, then what else is pension fund liabilities. There's sometimes provision you create, there will be unwinding of interest. Interest relating to those kind of liabilities and income and expense from financing liabilities will come under financing activities. Okay. Do you see any problem in this one? For example, interest on a financial asset, where it will be? In a financial asset. For example, financial asset. You have a financial asset in your balance sheet. You get interest from that. Investing. You are a bank. What is your financial asset? Loans. Well, so will this definition create an issue? Of course. You put it, if you go by investing definition, it will get into investing, but actually it's an operating. So standard set is, yeah, so that's what I'm saying. You cannot just go by the definition. So standards clarified it. It says, this is the definition, you go by the definition, but if your business, the main business is into investment and financing, yeah, then it may fit into some of the things which come into investment. If you are an investment company, it will go to operating. If you are a financing company, for example, banks, investment income, interest on investments, interest expenses, everything will go into operating. It will not sit in investment and operating activities. And it can be really complicated for group companies. For example, you have for a simple example I give you, as a group, you are into car manufacturing, dealers and everything, okay? So everything, trading activities. So you may have another subsidiary which is just only into investment, okay? He has an investment property. How will he classify his income, investment income? Huh? Operating. And the group? Investment. So it would require, complicated groups will have its own problem. It looks simple, but they can. Some companies like Omniways, or I don't know how the, the Oman oils and all, they have to see how the combination is. They have to define. ECWays, everything is my operating. You cannot. Ideally, that will give a wrong impression to the investors, right? Some people want to call them as a real estate company, or some of them want to call them as whatever it is. Okay? So the standard is not very strict about within that how you present. But it says, by definition, anything comes as operating, by this definition, you have to put it in operating and you have to give a subtotal operating. How you present within that is completely up to you. And it may so happen that Omantel and ideally, Omantel and Ooredoo should have similar operating. Within operating, how they do it, it's up to them. Someone may say gross before operating profit, he may give gross sale, cost of sale, gross profit, some other activities, then he comes. Others may not do sale and all, they may come straight to operating. And within operating, you may by nature or by function, you can mix it. Yeah. So that is it's the standard, and it makes sense. End of the day, key numbers is that how you present within it, leave it. You cannot control it. Then you are giving the format. That's not there. Yeah.
Is it not called the statement of comprehensive income now?
Yeah, that's why name is all same. Only change is this subclass. Yeah. So more of trying to achieve the consistency over the key numbers. You have to keep that in conceptually. So for like this. So if it's a pure manufacturing company, this will be the format. Okay. Now this operating profit has come. Previously, people would have been doing like this, gross profit, then they may come up to this. Now it's not. You have to give this. Then there is one item, which is, see, operating profit, this is investment activities. Yeah. What it says is, you are familiar, right? Share of profit from associate or joint ventures. It should always be under investment. Yeah. Even if you are an investment company, still you have to present that equity accounted always in investment. There is an option. You have to keep it there. Then interest, and you have the new mandatory. This is profit before finance and income tax. In other words, profit after operating and investing activity. Then you put all financing here. Then you get profit before income tax. Or in other words, profit after operation, finance and investing. Okay. Then you get income tax expenses. Rest is all same like previous year. Now, if a retail company is a group, you have some of your subsidiaries as, or you think, for example, if you are a car seller, but the financing of your customers is one of the key activities of the things. So if you have, for example, interest income on that one, it may come as part of operating activities, not necessarily investment or financing activity. Yeah, it can be retail or on the trading, manufacturing. If you, for example, car supplies, right? So some of the companies are, instead of giving third-party finance, it may be part of your sale. You yourself giving, it's a part of your normal trading activities.
What about interest on normal working capital?
It will be, it's financing. Yeah.
Income only will be.
Yeah. Now, because you are not you are not giving the borrowings, no? You are taking the borrowings, right? So it's not part of your business. You are not a lending company or anything, yeah.
So in this case, whether if they have taken loan to give further financing, you are telling it will be coming in finance.
Financing. It will be in the financing. because that's financing your business, right? It's not your activity. You are not a financing.
You said one automotive retail.
Okay.
They sell cars, but they give finance to their customers.
Yeah.
But they have borrowed money to make give lending to the customer.
Who takes the loan?
This is automotive company or maybe retailer.
No, that automotive company takes loan. It's your. It's not your business, no. You are not into. For the bank, it will be this one. In your business, what you are financing, that is part of your business. Other one, the other finance is the business of the bank, not your business. Yeah. Okay. This is maybe this is how a bank's financial statement would look like, because for them both investment and financing would be his operation. Okay, so everything comes here. So ideally there should be a subtotal here, but only his investment activity will be share of profit from associates and joint venture. In this ideal there should be a profit before financing here. Then this comes, then profit. Yeah. So for a bank it may be very less, unless so they may not have an investment category itself. If they don't have investment in associate, it may happen. Similar to insurance companies. Anyone who have done insurance, they have this investment. It's all part of insurance revenue. Everything will go into insurance revenue. Nothing will sit as part of financing and investment. This is an interesting one. MPMs. Yeah. Management performance measures. What it says is, if you are a listed entity, watch out on this requirement. It's a very interesting one. What it says is, you have to go through your publication, not even annual reports. If you have investor presentation, every quarter you do investor presentation, you have to see what you are presenting there on. Okay? And you have to identify the performance measures that relates to your income statement. For example, if you are reporting total assets, total liabilities, no problems. Okay? But if you are reporting numbers which relates to your performance, like revenue, gross profit, EBITDA, adjusted profit, adjusted EBITDA, adjusted whatever things you call, take all of them. Now, you need to have a separate note in your financial statement to deal with these items. It's part of financial statement. For example, you have now a note, right? Risk management. Anybody understood what it is? Okay, market risk, price risk, everything. Copy paste. Only liquidity risk, aging and all people understand. Rest is sensitivity. Make sure you copy paste properly. That's the only advice usually I give to my clients. At least tailor it. So similar to risk management, now you will have a new note which relates to MP. Okay. So you have to identify in your, that itself is a task. So you have to be a little bit consistent on what you present to the annual reports and investor presentation. You have to bring all the measures into your financial statement under this note, and there are some requirements. This would look like a kind of, for example, if you are reporting adjusted profit in yours, so you have to give a reconciliation of this number, and that reconciliation should start from a particular number which you reported in your income statement. For example, if you are giving a number adjusted profit, you have to give, for example, profit before tax or profit after tax in the income statement. Then you give the reconciliation. How you do it? So add back, like how you do it, taxable income kind of calculation, you have to give it. And the interesting part is you have to give this, see this question, and you have to, on that you have to see, for example, if you started before tax, you have to give what is the tax impact on that. How to compute? On the tax impact on individual items, it depends. Yeah. Then you come up with, if you have if you are a group entity, the non-controlling interest and attributable to the parent. You have to say how much of this is attributable to net non-controlling interest. That also has to be disclosed. So it's a bit of work, okay? And you give it. For example, if you are giving EBITDA, your starting point may be profit before before tax, or it may be operating profit. Then you add back all these numbers and you have to do it. And top of it, in that note, you have to describe what is this measure is. For example, adjusted profit means what, how it's calculated. You have to give a description. Then you have to give the reconciliation, and you have to say how it's imported. So if somebody goes and management analysis report, he will see the same number here and there. So that the requirement is, it's trying to give investors more information about the number or the stories you are putting it in the management performance analysis in the financial statement. And secondly, they get an assurance because it gets audited. Now it's part of your financial statement. Okay? That's a kind of requirement. It's quite interesting. The problem is now, another requirement is you have to give the comparatives.
For this also?
Yeah. So what usually happens? This year he gives EBITDA, next year he gives adjusted EBITDA. So if you change the measurement. So note, its requirement is quite extensive. You say, for example, last year you presented adjusted profit. This year you are not presenting it. Instead of that, you are presenting EBITDA because that's more suitable. For valid reason maybe. So you have to explain why you discontinued adjusted profit and you came up with EBITDA. Then EBITDA, you have to give the comparatives, which was not there in the last year. And you go to the auditor, he will charge you extra fee because it's not audited part, it's an additional. You don't, it's not strict, but at least you have to explain. So it's becoming almost like a financial statement, that is, because it's becoming part of financials, right? So it's an interesting story. We'll see. So it's like you and auditors will have discussions. What you have presented last year, what is not presented, whether it's really belongs to income statement, all those kinds of discussions. Yeah.
Over a period of time, the reporting requirements also changes.
Yeah, changes. Because investors want. So if it's an investment banker, I don't think any of the investment banks looks at your profit. They looks at EBITDA and those kind of numbers. And most of the stories are in the management analysis.
Sorry, but in the report, in the auditor's report you are giving, saying this auditors reviewed not only the financials, other information also.
Other info, he doesn't give any opinion or assurance on that. If you read that language, it's very beautiful language. Limited assurance, no assurance, those kind of things. It's there in the report. But most of the times, I haven't read it because it came after. That is also there. So all this thing. Now you cannot do. You have to give opinion. It's very different. Okay. So this, the why it changes, it's that what I'm saying. Some of the amendments, if you look at the backgrounds, it's a completely different. Okay. This standard is from an investor. The first one was regulator because somebody has played very smart. Next one was more of a clarification measurement. This one was to help the investors. You have to balance everyone. So there is something required to help the preparers of financial statement, right? So before we end the day. So next standard is to help the users, preparers of financials. Then there is some changes in the cash flows. Now, if you are using indirect method, previously we used to start with profit before tax, right? Now we have to start with operating profit. Operating profit, because ideally that should be your operating, yeah? You have to start with operating profit because operating cash flows, so start with operating profit, do all adjustments and do it. There's something something is wrong there, okay? Now they're saying operating and investing previously there are some accounting policy choice. Now there's an accounting policy choice. If you put it in investing, it's an investing cash flow or operating this one. Dividend is always financing activities, I guess. Rest all same, okay. Now this one is there, but I don't know. This is a good news for the preparers, but it's a good news. How many of you will this standard will be applicable is a question. Now this is a standard IFRS 19. It's first of all you say whether the standard is applicable to you or not. It's applicable to a company which is a subsidiary or a parent for which there is an ultimate parent. So within the group you are, okay. That's the first condition. Second thing is, where is the, okay. So it's a subsidiary. It doesn't have the public accountability. That is means you are not a listed entity. Public accountability means you are not a listed entity. Your shares or debt, even debts are not. Now it's very common in this market. You are not listed in stock market, but your debts are, bonds are listed. Then also you are a public listed entity. Secondly, you are planning for IPO. That is also very common. So this is not applicable. Thirdly, you hold some assets in a fiduciary capacity. That's a large amount of public money you are holding, like banks, insurance companies, portfolio managers, this kind. If you have this kind of public accountability, you cannot use it. So you are not a public accountable. Last is, the third requirement is, okay, you are a subsidiary. You are a subsidiary. You don't have public accountability. You are getting into consolidated to a parent company or ultimate parent company, and your parent or ultimate parent issues a consolidated financial statement, which is publicly available. Then this standard you can use it. Now what is the what this standard says? Key thing to understand. If you look at any standard, there are two parts to it. One is recognition, measurement principles and everything. Okay. The third one is disclosures. Every standard will have classification, recognition, subsequent measure, then disclosures. Okay. What the standard says, if you qualifies to, if you are a company that qualifies, as we mentioned earlier, you have to you have to comply with all the recognition and measurement principle of all IFRS. There is no. But when it comes to disclosures, you can apply this standard. So this standard is written in a way that it's also some multiple pages. What it does is, this standard, if you look at the standard, it says, first of all, applicability, it's applicable to which company and all the stuff it gives. Then it says certain requirements which will come to. Then it says, then it gives a list of disclosures. For example, it say IFRS 16, what is to be disclosed. IFRS 15, what is to be disclosed. IFRS 9, what is to be disclosed. Each standard it gives. Okay. That is a list of disclosure. Advantage of it, for example, if you take IFRS 15 disclosures, it will say 5 items or 6 items. If you go and compare it with IFRS 15 standard, you will say maybe 50 requirements. Here you will see maybe less. Okay, half. Okay. So for example, IFRS 16. For example, one of the disclosure, if you are a subgroup, you will have associates and joint ventures. You give financial results and a lot of things of your associate joint ventures. But if you go and look at IFRS 12, which is applicable for joint ventures and you will see very less disclosures. So if you're a sub-subsidiary, you don't have to have all the required disclosures required in your statutory financial statement which you prepare. That is the thing. We don't want to go into too much details of this. So only thing is, if you think that this standard is applicable for you, you can apply it because you are a subsidiary and your parent is listed. He prepares the consolidated financial statement. You are not a listed. You don't have any public accountability. You can account it. This can help certain companies, like if you are a real estate companies, these kind of construction companies, a lot of things, and you are a subsidiary. There are a lot of disclosure when it comes to IFRS 15 16, this joint ventures and all, you can cut on all this because those IFRS 15 disclosures are quite stringent. And I have seen most of the people doesn't give it because now it's not a compliance. Okay. So for example, IFRS 12, this is the joint venture financial information about your associate joint ventures is significantly cut down. 88% is reduced. IFRS 15, 52% of, especially like construction performance, future performance obligation, those kind of disclosures significantly cut down. IAS 12, income tax, IAS 16, anyway, IAS 16, 64% means still you have to give that table. But the requirements are very less. After this, certain things goes, the percentage increases very high. So that's the only thing. So there is a thing. So if you think that it helps you to, if it is satisfied, if you think my disclosure are too much, you can go back and check this disclosure requirement. You can cut it. Okay. Now parent has to be there. So that's the thing. The parent or ultimate parent, his financial statement should be publicly available. It can be listed. Publicly available, sometimes people issue, publish their financial statement on their website and all the stuff. Then also.
In other words, if the parent company is also not listed, it's a normal private company, then we have to follow all the disclosures.
Yeah, you have to, unfortunately. Or ask your parent to put on the site. I don't see big difference because what I'm saying, generally in this market, closed companies, anyway, they don't give a lot of IFRS 15 disclosures and all this stuff. But there can be some industries, if you are a real estate group or something, within a group, which is, you are not listed, but the parent is listed, you can significantly cut down the disclosures in your local accounts, which you give to the banks and all the stuff. Work will not reduce because your parent will ask this in your group reporting. So, but at least the statutory financial statement, you can cut down significant this thing. I think it's maybe a limited, you are part of a group, but you have complicated real estate, property, this kind of, it can be significantly reduced. That's where the IFRS 15 complication comes.
Even if the company is not listed and then if the financials are published in their own website, still you can apply.
Yeah, so that means the definition of publicly available. Not your financials, your parents' financials. If your financial is put in, then you are public account. Yeah. And certain things is you see a compliance statement in your financial statement, right? This financial statement is prepared in accordance with IFRS, right? In that sentence, you have to mention we have adopted IFRS 19. So people know some disclosure wouldn't be there. That's fine. Anyway, you are not publicly accountable. You can give it. And the next year, and you can say you can come in and come out every time. So next year, if you want to full disclosure, you are happy with it, you can go. Come back, you come back. But the only thing is when next year when you put full disclosure, you have to give the comparatives. You cannot say last year I did not give the next one. But when you go back, you don't have to give it. So that's the only thing. Any questions?
Give one case, where this could be applicable. One real case.
Real case, not yet. We'll see in 28. But there are companies. For example, this companies. No, for example, Omantel has subsidiaries which are not listed. Oman Data Park. There are other companies. OmniWest has a lot of which are not listed. Okay. Those can be significant, complicated subsidiaries. If they present financial statement, they don't have to put it.
When they consolidate,
and the parent they have to give. That's what I'm saying. It may help you on your statutory financial statement, but you give the group reporting, you have the information because here we will know it. But the only thing is, it will Excel format, it may help you, but drafting all these disclosures, notes, everything in the statutory, finalization of the statutory financial statement would be quicker, one thing. Secondly, that financial statement goes to many people, right? You don't have to give many informations there. For example, you can cut down significant disclosure when it goes to your loans or banks and other things. They don't want to see all those things.
difficulty is only first time. And already once things already once time financials are made, it become very routine thing.
It depends. There is significant disclosure cut downs on IFRS 9 disclosure, credit risk and other things, sensitivity. The thing is, there are a lot of things required as per the standard which if you are not listed, we are not giving, like sensitive analysis. IFRS 15, I haven't seen even listed companies really giving the performance obligation, future performance obligation disclosure. Anyway, we are not giving. That's why we don't feel the pain. So, for example, if you're a construction with real estate kind of guys, the future performance obligation under IFRS 15 is quite significant. And so it's a bit difficult, very judgmental to calculate those numbers. How you calculate timing of the future performance obligation, how you calculate those numbers and all the stuff. Any questions? No, just on time.
Just advantage of sale come leaseback transactions.
Sale and leaseback.
Can you just explain it to me? I think it's separate class. Two things. One is a lessor and another is a lessee. See, a computer, I don't have the money to buy outright. So over a period of time, I pay it out as an outright.
No. It's not that. It's not. It's like you need money.
Yes.
Okay. How will you say? You have to sell your asset. Okay. Then you get money. But you have to use the same asset in your business also.
Like I sell my house, but I stay in the house.
Yes, exactly.
And I pay rent.
I pay rent. So that is a sale and leaseback. Okay. So you want the finance from the banker, but he will not give you the finance. What you sell it to him. You get the price of the house. Then you rent it back.
And the owner becomes an occupant.
Occupant. That is sale and leaseback. So it can happen in two ways. One is you sell it, but the terms and condition is in a way that I'm not really transferring the control of the asset, because there will be a purchase option and other things.
Short-term liquidity problem. That's why I'm getting into this agreement or something like that.
Yeah, exactly. So it's a kind, in that effect, it will become a kind of financing. Yeah.
So when I account it, I have to account separately as a lessor and a lessee, or I have to net it off.
There is no lesser and lessee. You always be a lessee in that case. Where is the lesser? The first leg is sale.
It's like you're deemed to be sold.
Yeah, it's a sold. Yeah. Yeah. You lost ownership, then it's sold, and you got the money. Okay. That comes as a consideration. Yeah, debit bank. Then you have to. Then now there is a lease which you have to right of use and lease liability you have to put in back. So you are always a lessee now. There is no question of lesser is now the bank.
It's a bit complicated.
As always, yeah, it's a bit complicated. It's not a bit complicated. It's really complicated. The way the standard gives you option to measure the right of use asset and gain, you can come up with three models, and three models will give you different. The standard says ideally if you apply everything, it would give almost the same result, but it can. But if you're really smart, you may tweak.
Thank you, Mr. Robin, for such an insightful session. This was the last CPE session for current calendar year. Thank you for your attendance. May I request Past Chair Sir Jean Joseph to felicitate Mr. Robin. Also, MC on the stage. We have, I think, only 50% MCs available. Jay, Urmiji, please. Those who have done ICAI, any course conducted by ICAI in current calendar year 24.
You were here. I didn't see.
Announcements and on the community
On the last?
few times. So those which we have done and not informed, please get in touch with managing committee. We can inform as from our Muscat chapter. These are the members who have done additional courses.
Resolved with the Rajan?
by ICAI.